Good morning, everyone. We are from Tutorial 6, Group 6. Today, we'll be presenting our investment advisory report on Panasonic Manufacturing Malaysia Berhad. Our analysis evaluates the company financial performance, capital structure, and investment attractiveness over the period from 2021 to 2025. Let me briefly introduce our group. I'm Ang Wenjia, together with Yap Hui Ling, Suhaila Alam, Oliva Tosi Swim, and Nusaiba Tasim. Before we begin our presentation, we would like to declare that generative AI tools were used solely for language editing, data summarization, and idea checking. All analysis, interpretation, and calculation were independently conducted, reviewed, and verified by the group members. With that, let's begin our presentation.
First of all, let's introduce the company which we will be reviewing today. To start off, Panasonic Manufacturing Malaysia Berhad was founded in 1965 and opened in 1967. They started out as a dry cell battery manufacturer, and now they are currently one of the biggest producers of household electrical appliances throughout the entire country. They are focused on developing the electrical and electronic manufacturing industry, while also at the same time focused on creating new technologies to help develop the nation as a whole.
Next, I'll be presenting the financial performance analysis of Panasonic Manufacturing Malaysia Berhad from 2021 to 2025, highlighting the key trends and developments in the company's performance over the 5-year period. Firstly, let's examine Panasonic profitability performance over the 5-year period. As shown in the graph, both gross profit margin and net profit margin declined significantly in 2022 due to pandemic-related disruption, rising material costs, and flood-related operational challenge. Both margins recovered in 2023 and 2024 as business operations stabilized and economic activities resumed. However, profitability weakened again in 2025 due to inflationary pressures, global economic uncertainty, and weaker revenue performance. Overall, Panasonic profitability remained volatile throughout the 5-year period despite signs of recovery after 2022. Next, let's examine Panasonic return ratio performance through return on asset and return on equity. As shown in the graph, both ratios declined sharply in 2022 as weaker profitability reduced the returns generated from the company assets and shareholders' fund. The ratio improved in 2023 and 2024 as financial performance strengthened and the company utilized its resource more effectively. However, both ROA and ROE weakened again in 2025 due to lower earning performance and uncertain market conditions. Overall, Panasonic efficiency in generating returns from its asset and shareholders' fund remained inconsistent throughout the 5-year period. Next, let's examine Panasonic activity ratio performance, which reflects how efficiently the company utilized its asset and managed its inventory. As shown in the graph, both asset turnover and the inventory turnover declined in 2022 due to lower production capacity, weaker sales activity, and flood-related operational disruption. Inventory turnover improved significantly from 2023 to 2025, indicating faster inventory movement, tighter stock control, and improved operational efficiency. However, asset turnover weakened in 2024 and 2025 as revenue growth slowed due to weaker market demand and the discontinuation of certain product lines. Overall, Panasonic improved its inventory management efficiency over the 5-year period, although its utilization of total assets remained inconsistent. That's all from me. I will now pass the presentation to my teammate.
Thank you, Wenjia. Next, I'll present the company's financial performance from the perspective of liquidity and leverage. Specifically, I'll focus on 3 areas: liquidity ratio analysis, debt and financial leverage ratio analysis, and interest coverage ratio. For the first part, let's look at liquidity. For liquidity, Panasonic Manufacturing Malaysia Berhad showed a very strong short-term financial position throughout the 5-year period. In 2022, the current ratio, quick ratio, and cash ratio declined slightly due to pandemic-related disruptions, flood recovery, and higher working capital pressure. However, from 2023 onwards, liquidity improved significantly. By 2025, the current ratio reached 5.32 times, the quick ratio was 4.92 times, and the cash ratio was 4.15 times. This means the company had more than enough current asset and liquid asset to cover its current liabilities. Overall, Panasonic had very low liquidity risk. However, the very high cash ratio may also suggest that the company is holding more cash than necessary, which could reduce capital efficiency if the cash is not reinvested productively. Now moving on to the second part, which is debt and financial leverage. For debt and financial leverage, Panasonic showed a conservative capital structure. In 2022, both the debt to equity ratio and debt ratio increased slightly, reflecting the impact of operational challenges and higher liabilities during the recovery period. However, from 2023 to 2025, both ratios declined. The debt to equity ratio decreased from 19.67% in 2021 to 14.94% in 2025, while the debt ratio decreased from 16.44% to 13%. This shows that Panasonic did not rely heavily on debt financing. Most of the company's financing came from shareholders' equity rather than borrowings. Overall, Panasonic debt level remained manageable and its low leverage position reduced long-term solvency risk. Next, I'll explain the interest coverage ratio, which measures the company's ability to pay interest expense using operating profit. For interest coverage, Panasonic showed a very strong ability to meet interest payments. From 2021 to 2024, the ratio remained extremely high because the company had very low finance costs. In 2024, the interest coverage ratio reached 72,873 times, mainly because finance costs were only 1,000. In 2025, the ratio dropped sharply to 653.97 times. However, this decline does not indicate financial distress. The drop was mainly due to lower operating profit and a slight increase in finance costs. In 2025, Panasonic still generated 20.27 million ringgit in operating profit, while interest expense was only 31,000. Therefore, the company could still cover its interest expense more than 653 times. Overall, Panasonic's interest payment risk remained very low. To conclude my part, Panasonic Manufacturing Malaysia Berhad is financially stable in terms of liquidity and leverage. The company has strong short-term repayment ability, low debt dependence, and very low interest burden. Therefore, the main risk is not financial distress, but weaker profitability, softer revenue growth, and whether management can use the strong cash position more efficiently. That's all from me, thank you, and I will now pass it to my teammate.
Alright, so now we will be looking at the cost of capital evaluation of Panasonic Manufacturing Malaysia Berhad. To understand Panasonic's cost of capital, we must first look at its incredibly unique risk architecture. Unlike most manufacturing firms that load up on bank loans to fund factory expansions, Panasonic operates with a strict zero debt capital structure. Mathematically, this simplifies our calculation because the weight of debt is zero, meaning Panasonic's weighted average cost of capital is driven 100% by its equity. Alright, now let's look at the mathematical reality of our 5-year cost asset pricing model timeline. The most striking takeaway here is how changes in the macroeconomic environment directly dictates Panasonic's hurdle rate. Notice that back in financial year 2021, when monetary policy was highly accommodative, Panasonic enjoyed a remarkably low cost of equity at 3.47%. As inflation hit in financial year 2023, the risk-free rate jumped to 3.91%, driving their cost of equity to its peak at 4.15%. By financial year 2025, the market stabilized, setting Panasonic at 4.22%. What this proves is the beta buffer effect. Because the company's beta is locked at 4.04, it effectively neutralizes market risk premiums. The security market line graph visualizes the entire dataset by comparing the security market lines for financial year 2021 and 2025. This graph maps out exactly how macroeconomic forces reshaped required investment returns. The line for financial year 2025 has a noticeably steeper slope compared to 2021. This occurs because the general market risk premium expanded from 5.85% to 6.20% over the 4-year cycle, showing that the investors demanded higher risk compensation. Panasonic's cost of equity shifted marginally from 3.47% to 4.02%. The graph proves this visually that Panasonic's hurdle rate rises only because government cash yields rose, not because its business model or operations became riskier. In standard finance theory, no debt means a higher weighted average cost of capital because equity is traditionally more expensive than debt. However, because Panasonic's equity risk is so low that their weighted average cost of capital remains heavily deflated anyway. Let's look at it in the next slides.
Moving on to cost of debt. Total debt was represented by the sum of current and non-current lease liabilities. As Panasonic has minimum borrowing apart from lease obligation, the after-tax cost of debt remained relatively stable between 2021 and 2024, ranging from 2.48% to 2.81%, indicating consistently low financing costs. However, in 2025, it increased from 3.90% due to higher lease liabilities and finance costs. Despite this increase, the overall cost of debt remained relatively low, reflecting Panasonic's conservative capital structure and low financial risk. Moving on to WACC, weighted average cost of capital. The total value of the company was calculated by adding the market value of equity and total debt. The market value of equity was derived using the year-end share price multiplied by the number of outstanding shares, while total debt consisted of both current and non-current lease liabilities. The company total value was then used to determine the proportion of equity and debt in WACC calculation. What is WACC? WACC, or weighted average cost of capital, represents the overall cost of financing a company through both equity and debt. It is commonly used to assess investment opportunities and to determine the minimum return required by investors and creditors. Panasonic's WACC increased from 3.47% in 2021 to 4.15% in 2023, mainly due to a rise in risk-free rate. It then remained relatively stable at around 4.0% until 2025. Since equity accounted for more than 99% of the company's capital structure, WACC was primarily influenced by cost of equity. Although Panasonic's share price declined significantly over the period from RM31 in 2021 to RM16.50 in 2025, resulting in a significant decline in market equity value, its WACC remained relatively stable due to its consistently low beta of 0.04. Now we shall conclude our findings. We can see that Panasonic Manufacturing Malaysia Berhad (PMMA) has an overall unstable financial position. As shown by our financial ratios analysis, we will find that they have frequent fluctuations in their financial ratios. This shows inconsistency and also a continual decline in revenues, especially viewed in the year 2022 and as of late 2025. Their management, however, is well kept and effective, meaning that they are able to quickly tackle problems faced without much difficulties, as well as to recover from their losses. As we can see in year 2023 and 2024, there has been a slight increase due to them managing the problems of the flight cost in 2021, as well as the high rise in raw material prices, and also recovery from the prolonged COVID-19 lockdowns. Next, let's look into PMMA's overall cost of capital evaluation. We will find that most of PMMA's financing comes from equity, meaning that their fixed obligations or debt are kept to a minimum. This results in that should the company go bankrupt, there will be more payout towards their investors and company owners as they have little creditors to pay back. However, this will result in a decrease in tax deductions. We have also found out that their rate of return is low, with a value of up to 4.02% compared to the market's rate of return, which is 9.98. However, their risk is also equally as low, with their beta being 0.04 compared to that of the market of 1.00. Next, let's take a look at some of the external drivers of PMMA's performance. First of all, we have the pandemic, which strictly refers to the COVID-19 lockdown. Due to some strict manufacturing control orders, MCO, production was halted, especially in the plants of Shah Alam and Melaka, which were forced to be shut down. Their workers were also infected, causing crucial for sanitization, with a report of 116 workers being infected with the disease. There was also a discontinual of many of PMMA's product lines due to inability to import specific components from overseas, namely China. Next, let's look into inflation. The high rise in inflation rates has caused profits to drop as of late 2025. This is due to an increase in the price of raw materials, resulting in PMMA increasing the price of their products itself. This, however, backfired, as we later see that there will be a decline in the demand from customers. Last but not least, let's look into some investment advices on the PMMA stock. It is not very advisable to invest currently, as there is uncertainty if inflation rates will come soon. This may result in PMMA facing a bigger decline in revenue and finances in the upcoming years. The expected rate of return for the PMMA stock is also low as compared to that of the market return. However, this may appeal to risk-averse seekers which might consider buying the PMMA stock as they impose a low risk level. For current investors, it is advised for them to hold on to their shares. However, if there really is a further decline in the PMMA stock, it is advised for them to sell off their shares quickly to avoid any further loss due to investment. That is all from us. Thank you very much.